Dear clients, dear colleagues, dear friends, my name is Thierry Lesage. I'm a tax partner at Arendt, and it is my privilege today to kickstart the Tax Week. It has now become a great tradition to connect with you during an entire week in January through this series of webinars. Capitalizing on the strength and expertise of our tax professionals, more than 50 tax professionals at Arendt, this series of targeted and interactive webinars allow you to pick and choose the topics that are mostly relevant for you, and also to keep abreast of key tax developments in tax law. We have today a nice program. I will present you the program for the whole week. Today, Eric Ford and Philipp Jost will discuss general trends in EU and international tax law. Tomorrow, Alain Goebel and Alexandre Maschiella will address the key takeaways that are to be taken from recent case law on transfer pricing. On Wednesday, Jan Neugebauer, Philippe Pardefoy, and Ivan Stebnerski will discuss recent developments in the field of asset management and what their impact is for Luxembourg. On Thursday, Vincent Mahler and Alexandra Cloutet will present some key market trends updates on real estate fund structuring. And on Friday, last but not least, Bruno Gasparotto, Claire Schmidt and Sophie Weiten will present what is expected in 2023 for VAT. Thank you for your attendance. I'm sure you will find these sessions very interesting. And of course, the whole team will remain at your disposal to further discuss the topics that will be presented during the week.
Thank you, Thierry. Good afternoon, everyone. I'm Sophie Richard, Counsel in the Knowledge Management Tax Team of Arendt. Thank you again for joining us today for discussions on EU and international tax trends. For these discussions, we have great speakers. First, we have Eric Ford, who is a partner in the tax law and private client practices of Arendt. Eric has approximately 30 years of experience advising on national and international tax issues. He has substantial experience on real estate, private client, private equity, and finance transactions. Welcome, Eric.
Welcome.
And then we have Philipp Jost. Philipp Jost is counsel in the tax law practice of Arendt. He has more than 10 experiences and specializes in tax structuring for investment funds, in particular for German investment and investors. And before joining Arendt in 2016, Philipp spent several years as a tax lawyer with an international law firm in Germany. Before we get started with this presentation, I would like to share with you the usual housekeeping rules. There is a Q&A section where you can ask your questions, and the speakers will address them after the presentation. And also, if you have any technical issues, you can ask your questions in the chat box. Now, Eric, Philippe, I'm very happy that you will share your views on recent and upcoming trends and developments in the tax law field that may impact our clients.
Thank you, Sophie. Ladies and gentlemen, welcome to our today's section. It's about the general trends in international taxation. As you can see on the following slide, during 2022 and the European Commission, with all its publication, initiatives, proposals and action were really ambitious. We're gonna outline today and for the 30 upcoming minutes not more than 12 different action and items on a very high level. As you can see, there are several building blocks starting with 8, 1, 3 and 4. We're gonna go through deck 7 and 8, then pillar 1 and 2, and then you're gonna find some exotic acronyms like DERA, BEFIT, FASTER, and we're going to end then by the European blacklist, the public country-by-country reporting, disclosure, and before we end with some final words about state aid. Let's start with ATED 3. Already last year, we announced the publication of the European Commission's proposal in relation to ATED 3, so the Anti-Tax Avoidance Directive, which has as purpose to fight against the use of shell entities for tax purpose. The proposal sets out a list of features referred to gateways to filter entities at risk of lacking substance by reference of the proportion of passive income, cross-border activities, or whether the day-to-day administration or the decision-making of significant function are outsourced. As you know, the directive will impact the taxpayer by tremendous increase of reporting obligation. It will also have an impact on the exchange of international exchange of information, and it could lead to the denial of the certificate of residence for companies which are deemed to be at risk. The taxpayer should monitor the progress of the Unshell directive. It is still underway. During the Czech Republic and the Swedish presidency of the Council, there were tough negotiations. It's going to be the same now under the Spanish presidency. We expect to have in mid-year 2023 a result, and it will not be the outcome of the negotiation will not reflect exactly the proposal as it has been published in 2022. In the meantime, also the European Parliament exactly last week has adopted its own version. They fear that since you need an unanimous vote of the ATED 3 directive, it risks not to go far as they want to have it. But as you know, we expect that the Parliament's version will not have a real impact. Returning to ATED 4, so ATED 4, it's also called SAFE. SAFE stands for Securing the Activity Framework of Enablers, and the SAFE is framed as a complementary initiative to the Unshell directive. Its objective is to prohibit enablers or advisors and intermediaries who design, market, or assist in the creation of the tax arrangement or schemes in non-European countries that lead to tax evasion or aggressive tax planning for the EU member states. It should also set clear and objective criteria for defining the forms of aggressive tax planning that are prohibited. Three options are discussed: either the requirement for all enablers to carry out dedicated due diligence procedures, or the prohibition on facilitating tax evasion, aggressive tax planning combined with due diligence procedures, and a requirement for enablers to register in the EU, or a code of conduct for all enablers. The timeline, now you can put it on your agenda. It has been published very recently. It is planned that the SAFE going to be, there will be a proposal on June 7th, 2023. It will go along with another initiative where we come on later, is the FASTER. And yes, and let's and we have to see the outcome of the consultation. Let's turn to DAC 7.
Thanks, Eric. DAC 7 and DAC 8 These are actually two amendments to the DAC directive, and the DAC directive, as we all know, the directive on the administrative cooperation between the tax authorities. Let's focus first on DAC 7. DAC 7, we already have an implementation bill in Luxembourg, which is very well advanced, but hasn't passed yet. The bill is basically, or the DAC 6 directive is basically dealing with different topics, quite prominently foreseeable relevance. There is a dedicated article on the standard of foreseeable relevance in the framework of information requests in that regard, and that's quite interesting because before the approval basically of the DAC 7 directive, the DAC directive only foresaw that member states could undertake to exchange of information to share in such procedure information which is foreseeably relevant in that context, but there was never be a proper definition. That has been changed now with DAC 7. Further, the bill also clarifies exchange of information requests on group of taxpayers that cannot be identified individually. Very practical amendment is the further enhancement of the rules for performing simultaneous controls and a framework which is laid down for EU joint audits, so that will very certainly have a practical impact on taxpayers within the European Union. Very importantly, there are also new measures on digital platform operators. So digital platform operators will have the obligation to register in Luxembourg and collect as well as report certain tax-related information such as income earned on the platform to the Luxembourg tax authorities, and the Luxembourg tax authorities then vice versa will report such information to the relevant EU member states tax authorities in that context. Registration for these digital platform operators will need to happen by 31st December of this year in Luxembourg. Obviously, if the business of such a platform provider is started after that date, then that registration needs to happen accordingly when the business is started. What are the reportable informations? Seller details, income earned on reportable transactions, fees and commissions earned by the platform provider, and all of that information needs to be kept for at least 10 years, and reports need to be issued by 31st of January each year for the previous year. Very quickly then on the second amendment to the DAC directive, which is DAC 8, still in proposal terms. DAC 8 basically aims at increasing transparency and accountability in view of crypto assets. There are two main features to the DAC 8 directive, which are reporting requirements for EU-based and non-EU-based crypto asset service providers, requiring them to report information on transactions involving crypto assets with EU-based users on the one hand, and secondly, certain due diligence procedures on them. So crypto asset service providers need to perform a due diligence on such reportable users who carry out reportable transactions within for EU residents, basically. And such service provider need to also collect certain self-certification forms, which we already are used to and known from Common Reporting Standard (CRS). Tax rulings is also quite a hot topic in view of the DAC 8 proposal. So with DAC 8, it will come into effect that advanced cross-border rulings and advanced pricing agreements need to be exchanged also in view of high net worth individuals. So what does high net worth actually mean in that context. So any individual will be considered as a high net worth individual who has at least 1 million in financial assets or investable wealth under management, except for the main residence. Quite interestingly and importantly, tax rulings issued, amended or renewed between 2022 and 2025 that are still applicable as of 1st of January 2026 will also be automatically exchanged in that context. And now leaving a bit the DAC directive and jumping into the very recent amendments and developments in view of Pillar 2. We just maybe as a reminder first, before we see what happened on the Pillar 2 side, as you know, the Pillar 2 solution, basically as proposed by the OECD, is to address the tax challenges arising from the digitalization and the globalization of the economy. And these mechanisms are expected to add an additional taxation right to market jurisdictions and to put a floor on tax competition through the creation of a global 15% minimum effective corporate income tax rate. And as I said, given the recent developments, before we talk about Pillar 1, let's focus on Pillar 2 first. As I said, Pillar 2 will basically introduce a tax system ensuring a minimum level of taxation for MNEs, multinational enterprises, with the mentioned 15% corporate income tax rate. And the Pillar 2 solution is now addressed in the new draft directive of 14th of December of last year, which will ensure such minimum level of taxation for MNEs and large-scale domestic group within the European Union. Member states have to transpose the directive by 31st December of this year with the income inclusion rule. So the IIR basically is the top-up tax for the parent entity being applicable for financial years beginning from 31st December of this year. And so to speak, the backup rule, the fallback rule, the undertax payment rule, UTPR, is basically the relocation of any residual amount of top-up tax in cases where the entire amount of top-up tax could be allocated by the parent entity will be applicable for financial years beginning from 31st December 2024, with a possibility to defer the application of such rules by 31st December 2029 under certain conditions. There's a dedicated session next Wednesday on recent impacts on the asset management industry presented by Jan, Yves and Yvonne, and that session will also see the impacts of Pillar 2 in the fund management world. So we would highly encourage you to tune in if you should have an interest on Pillar 2 in that context as well. And then if we can very quickly jump to the next slide already with the calculation. Yes, so basically how you compute the top-up tax, it's a three-step approach. On the one hand, and to spare you the technicalities of the formula, first you need to compute your jurisdictional effective tax rate. Then in a second step, you would need to compute the jurisdictional top-up tax. And finally, then the allocation of the jurisdictional top-up tax to the constituent entities will be done. And then finally on Pillar 1, just very quickly, Pillar 1, as we know, aims at reforming the international allocation of taxing rights, and broadly speaking, by providing a mechanism for taxing rights to be more closely aligned with market engagement. So you will look basically at the people and consumers' functions and where they are located. From an agenda timing perspective, there's not so much to say, but we would expect the OECD to finalize Pillar 1 by mid-2023. But as such, the details of the initiative, as we have summarized here on that slide, may still be subject to change, and there currently remains some amount of uncertainty in that regard. So with the two-pillar solutions, I'll hand it over to Eric again with some fancy abbreviations.
Right.
As I can see.
Thank you, Philipp. And as let's turn to DEBRA. And you notice that the European Commission is getting more and more imaginative when finding funny acronyms. Here, DEBRA, what it stands for Debt Equity Bias Reduction Allowance. It is the result of the asymmetric tax treatment between debt and equity, as you know, where interest on debt financing is tax deductible as a rule, whereas dividend payments as a result of the allocation of profits aren't tax deductible. And of course, this bias or asymmetry potentially favors the use of debt. In the eyes of the European Commission, excessive debt makes business more vulnerable, and there's an increase of risk of insolvency in times of crisis, as it can be the case nowadays. So the idea is to reduce this bias by, we would call it a stick and carrot rule. The stick, so to disencourage the use of debt, is to add a new layer of interest limitation on top of the ones that we know already from ATED 1. And on the other hand, to encourage equity financing by the introduction of a notional interest deduction on incremental equity. That is the idea. Worthless to tell already right now that it's gonna not be a balanced solution. The stick will be bigger than the carrot. Regarding the timeline, now in November it has been announced that the initiative is suspended in order to be reassessed once other proposals in the area of the corporate income taxation have been put forward by the European Commission. So we have to see and wait whether they're gonna ahead with the DEBRA and what would be finally the outcome. Another new acronym is, it is a new acronym, but it stands for an old measure, the BEFIT. The BEFIT stands for Business in Europe, Framework for Income Taxation. It's the European Commission in October 2020 published a call for an impactment assessment. And the idea is to pick up a very old measure, but which couldn't progress, since for this type of measures you need the anonymous vote of the member states. And I'm speaking about the CCTB, so the common consolidated corporate taxation. And it has been announced last year by the European Commission for the taxation of the 21st century, in order to facilitate and to make tax management more easy and less expensive, to have a uniformed and a single corporate tax rule book within the European Union. It is a very honorable initiative. Hopefully it will be more successful than its ancestor. The public consultation is still ongoing, and a legislative proposal is expected in Q3 2023. When it comes to the European blacklist, As you know, this blacklist is updated every 6 months. There are some newcomers on this blacklist, Anguilla, Turks and Caicos, and mainly also to mention Bahamas. And you have to keep in mind when your companies are dealing with blacklisted entities that going to have several tax consequences in Luxembourg. On one hand, you have to face a non-tax deductibility on interest and royalties paid to related parties established in those jurisdictions, but you have also to face disclosure and taxes reporting requirements. So take care, you have really to monitor the UE blacklist since it's going to impact you.
So, FASTER, another fancy acronym. What does it actually mean? So FASTER means faster and safer tax access refund. So I think we can all agree, whether we are on the retail side or on the institutional side, that the withholding tax reclaim procedure is quite burdensome, not to say extremely burdensome, for investors. And that has also been recognized by the European Commission, and the European Commission is now working on a European-wide withholding tax framework proposal to facilitate the process, basically, of refunds of withholding tax. And that draft proposal is expected to be released on 7th of June of this year. And as we know, the withholding tax reclaim, it can either come from, or the withholding tax reclaim rules, they can either come from domestic, so national rules, or they can come from applicable double tax treaties, as the case may be. And the initiative will likely be structured around 3 main elements. So, well, as the name says, an introduction of a quick refund procedure, hopefully the introduction of electronic tax residence certificates, and obviously the digitalization process and standardization of forms in that context, and that there is not a requirement of hard and wetting paper in that context anymore, as it is still the case for a lot of European countries. Quite interestingly, in that context, as you can see from the consultation process, there are well over 1,600 responses to it. So there seems to be really an interest in the market to basically fight against the reduced attractiveness of the European market in that context, and the basically potential of double taxation if you do not get your refund in that context. Eric, what do you have?
So some few words about the public country-by-country reporting, as well as the effective tax rate disclosure. As you know all, in 2021, in June, the Council could reach with the Parliament a political agreement on the publication and the public disclose of some data for some specific taxpayers, mainly the multinationals having a consolidated revenue of more than 750 million euro. And the data to be disclosed encompass the company's activities, the number of full-time equivalent employees, the amount of profit and losses before taxes, and finally the amount of the taxes paid. The provision to be implemented should be by June 2023, so the day before the Luxembourg National Day, to keep in mind that. But as regards Luxembourg, there is no draft provision available yet. Regarding the effective tax rate disclosure, the European Commission, in its communication on the taxation for the 21st century, included as an action, as a proposal for the publication of effective tax rate of certain large companies with operation within the European Union based on the methodology under discussion in Pillar 2. So far, we are not aware about any initiatives or more actual measures to be taken, but certainly we have to monitor this as well and see what's going to be the outcome. And I think we should have some last words regarding the European Court of Justice.
Indeed.
Trends and decisions.
Indeed, Eric. Very quickly on the state aid cases, to conclude our session, as we are approaching basically the end. There's an interesting new ECJ ruling on the well-known Fiat case. As for the Amazon and Engie rulings, basically transfer pricing rules also took center stage in the Fiat dispute. In the case at hand, the European Top Court found that the European Commission should have made a, broadly speaking, clearer comparability analysis and should have assessed Fiat's transfer pricing arrangements solely in light of the Luxembourg rules and the administrative guidance on transfer pricing instead of, a very global reference to the general corporate income tax system. That's certainly a very interesting development, and tomorrow our transfer pricing experts Alain and Alexandre will do a deep dive basically into that decision, and if you're interested on these transfer pricing developments, you should not miss the session tomorrow.
Okay.
Thank you, Eric, Philipp. Maybe we're a bit late, but would you like to take one question, maybe, or shall we take them for?
Well, we can take some question and answer more privately.
Yes,
but
sure.
as a final takeaway, you see that there are a lot of measures. I would even say a tsunami of measures which are underway, and that with the intention of the Commission, and they stress it every time, that they want to have a robust, efficient and equitable tax system, and for sure all those measures, a lot of them gonna impact you. So we can only invite you to monitor them really closely, and if you have some question, please don't hesitate to get in contact with us. Thank you.
Thank you, Eric and Philipp. Now it's time to close the session, and I would like to thank you, speakers, and you for joining us today. I remind you that we have the whole tax week webinars at 1 o'clock, and you can still register on our website. I would like also take this opportunity to share with you our training program of Arendt Institute. You can see the agenda here, and we can also organize customized sessions upon your request. So thank you very much for your attention, and have a good day.